Hey everyone, welcome back to Managing Your Business by the Numbers, where we take the complex world of business and make it simple and practical for small business owners, department managers, and anyone looking to learn more about running a business. Today we're diving into something that it might sound intimidating, but it's crucial for the growth of your business: capital budgeting. Now don't worry, we'll keep the jargon to a minimum and the value to a maximum. So if you're ready, let's begin. So what exactly is capital budgeting? In simple terms, it's the process businesses use to evaluate potential major investments or projects. Think of it as your business's way of deciding whether to buy that shiny new piece of equipment, expand your operations, or even launch a new product line. You wouldn't just jump into any of these without a plan, right? Unless, of course, you like living on the edge. But we're not talking about skydiving here. This is your business. Now, why should you, as a small business owner or manager, care about capital budgeting? Simple. It helps you allocate resources wisely. It's all about making sure your hard-earned money is working for you, not just sitting there like your uncle at a family reunion, taking up space but not contributing much. Capital budgeting ensures that your investments are aligned with your company's strategic goals. You wouldn't spend your marketing budget on a billboard in the middle of nowhere, right? The same logic applies here. You want your investments to move your business forward, not sideways. All right, let's break down the capital budgeting process into manageable steps. Think of this as your roadmap for making smart investment decisions for your business. There are 4 key steps to keep in mind. Step 1 is identifying investment opportunities. This is where you keep your eyes and ears open for projects that could benefit your business. Maybe your old equipment is starting to sound like a rock concert every time you turn it on. Might be time for an upgrade. Step 2 is evaluating those opportunities. This is where we get a little analytical. Now don't worry, I won't bore you with a ton of math. Think of it as weighing the pros and cons, like deciding whether to binge watch your favorite show or go to bed on time. You consider the benefits and the risks, then make an informed decision. But instead of losing sleep, you're managing your business's future. Next is step 3, selecting your projects. You've done the homework, now it's about prioritizing. Just like how you might prioritize coffee, over anything else in the morning. Pick the projects that align with your goals and have the best potential for success. And finally, step 4 is implementing and monitoring. You wouldn't just set it and forget it, unless it's a slow cooker. And even then, you check on it now and then. You need to keep an eye on these projects to make sure they're delivering the expected results. Now that we've broken down the process into steps, let's take a closer look at some of the tools you'll use during step 2, evaluating projects. These evaluation techniques help you figure out which investments are worth your time and money. Let's talk about some of these tools that you can use to evaluate these big decisions. These are fancy names for simple concepts, so stick with me on this. Each of these techniques has its strengths and weaknesses, and sometimes they might even give you different answers. So let's dive a little bit deeper. Net present value, or NPV, helps you calculate the present value of future cash flows. Here's the formula, but don't worry, we're not going to dive too deep into this. The key takeaway is that NPV considers the time value of money, which helps you to figure out if a project is worth it or not. When is NPV the best choice? NPV is your go-to when you want a comprehensive view of a project's profitability over time. It's especially useful for projects where cash flows vary significantly from year to year. Weaknesses of NPV. The downside, NPV requires you to estimate future cash flows and choose a discount rate, both of which can be tricky. If you're off in your estimates, your NPV might lead you astray. Potential conflicts. If you compare two projects, one with a high upfront cost and long-term payback, and another with quicker returns, the NPV might favor the one with long-term gains, even if it's riskier. That's where other techniques come into play. Next up is the internal rate of return, or IRR. IRR is the discount rate that makes the NPV of a project zero. Essentially, it tells you the expected rate of return from the project. It's a popular choice because it gives you a percentage, which is easy to understand. Everyone likes to talk in percentages, right? So when is IRR the best choice? IRR is handy when comparing projects of different sizes or durations because it gives you a straightforward rate of return that you can compare to your company's required rate of return. But here's the catch. IRR assumes that all future cash flows are reinvested at the same rate as the IRR itself, which isn't always realistic. Also, if a project has alternating positive and negative cash flows, it can result in multiple IRRs, which can be quite confusing. IRR might lead you to choose a project with a higher percentage return, but a lower absolute dollar value, which could be a problem if your business needs that cash flow to grow. The payback period formula is about as straightforward as it gets. How long it takes for your investment to pay for itself. While simple, it doesn't consider the time value of money, so use it wisely. So what happens when these techniques give you different answers? Well, that's when you put on your decision-making hat. If your focus is on maximizing total profitability and you're confident in your estimates, NPV is likely your best bet. If you're comparing projects with varying timelines or scales, IRR can give you a clear comparison. But if cash flow is tight and you need to recover your investment quickly, the payback period might be your guide. In reality, you'll often want to use a combination of these methods to get a fuller picture before making your final decision. Think of them as different lenses through which to view your investment options. The clearer the view, the better the decision. Of course, no investment is without risk. Identifying these risks and figuring out how to handle them is crucial. It's like packing an umbrella, even if the weather report says it's going to be sunny. Better safe than sorry. Finally, let's wrap up with some practical tips that you can start using today. Tip number 1, start small. Don't dive headfirst into massive investments. Test the waters with smaller projects first. It's like ordering a small coffee before committing to the event day. You want to make sure it's worth it. Tip number 2, seek professional advice. Sometimes it's worth talking to a financial advisor or accountant. It's like asking for directions when you're lost. Sure, you could figure it out on your own, but it might take twice as long and involve a lot more U-turns. In business, the U-turns can be expensive. And finally, keep learning. The business world is always changing, and staying informed will help you make better decisions. Plus, it gives you more to talk about at networking events than just the weather. So there you have it, crash course in capital budgeting that's practical, not painful. Remember, it's all about making smart decisions that will help your business grow. Thanks for watching, and if you found this helpful, don't forget to like, subscribe, and hit that notification bell. See you next time, and until then, have a great day.
this is done alright. We are through on repeat. Can we put this to sleep? All we need to is walk out the door. I think that none of us did wrong, but why didn't we end this right? Can we put this to sleep and just never repeat? All we need to is walk out the door. So come on, break it up now, break it up, honey. The satisfaction in you don't seem to be fine. I'm feeling crazy now, I'm really crazy now. But you and me should just break it all up. You're not alone in this, but now you're on your own. I forgot about your smile, yeah, it has been a while. Something made you unhappy, it's gone. I think that none of us did wrong, but we didn't realize. If we put this to sleep and just never repeat, we will happily walk out the door. Come on, break it up now, break it up, honey. The satisfaction in you don't seem to be fine. Feeling crazy now, I'm really crazy now. But you and me should just break it all off. Break it up now, break it up, honey. The satisfaction in you don't seem to be fine. I'm feeling crazy now, I'm really crazy now. But you and me should just break it all off. Go tonight, off we go tonight. The right thing to do. Can already see you smile, ready to see you smile, a girl I once knew. Off we go tonight, off we go tonight, the right thing to do. Can already see you smile, ready to see you smile, a girl I once knew.